So you're here to talk about James Gorman, which we will get to. But let's just start with what Jay Powell was talking about, that they may not need to hike as much as they originally thought due to the fact of the credit crunch. Now, credit tightening always happens with banks during a tightening cycle, right? Lending standards tighten. That's pretty normal. Is what we're seeing abnormal or normal?
Well, we had over 70 banks and financial companies at a two-day conference this week. So we have theory and reality. The reality is banks, many regional banks, are looking to shrink their balance sheets. They're concerned about the additional capital rules that might come into place. They have less deposits to lend out. There's more scrutiny on commercial real estate. And so, yeah, credit tightening is normal when you're approaching a downturn, but almost every effort of regulators in Washington, D.C. over the last 15 years was to have regulation to be counter-cyclical. What's happening now is pro-cyclical. As you approach a downturn, you're talking about increasing capital levels significantly. So, yes, that will have a dampening effect on the economy, and they're right to say and to recognize, like, maybe you shouldn't increase rates as much as you otherwise would.
Let's talk about the regulatory side a little bit more as well, Mike. Great to see you. It's Guy. Michelle Bowman was addressing this issue a little bit earlier on out of Dallas. Janet Yellen, we understand, has been talking to bank CEOs. This being reported by CNN. Bowman was raising the issue that if you increase regulatory requirements on small and mid-sized banks, you're going to see consolidation. You're going to see the market getting smaller. The U.S. has a lot of banks. Janet Yellen reiterating that. She's apparently been telling bank CEOs that more mergers may be necessary. Would you agree?
Yeah, I've agreed. This is my fourth decade of analyzing banks. I've agreed all 4 decades. I mean, you have almost 5,000 banks. That number should be cut in half over the next 10 years if normal economics are allowed to, take place. This idea of a fire drill bank merger of J.P. Morgan buying First Republic is not exactly ideal. So
what should they have done?
They should have allowed mergers more quickly over the last 15 years. They should make it easier. They should have expedited approvals. You had issues with bank mergers where they're trying to close a deal and they couldn't do it. That was my first job in finance. I worked at the Federal Reserve in the late 1980s, and there was a 60-day period when we tried to get mergers approved. And now this idea of restricting bank mergers. Look, the intent was fine. Don't have too much concentration of power among the largest banks. I get it, but it's had the opposite effect of deepening the moats around the largest banks. This talk about restricting bank mergers, I call it the Jamie Dimon Protection Act. Why are you trying to protect J.P. Morgan and Bank of America? You need more banks to compete against J.P. Morgan, which, by the way, is having their investor day this Monday.